Welcome to the deep dive. You see these big market numbers, and sometimes you really need to look a bit closer to get the full picture.
Definitely. Headlines don't always tell the whole story.
Right, so take the Indian mutual fund scene in March 2025. Phillip Capital's latest mutual fund Roundup shows total net assets under management AUM jumped 1.84%. That's up to Rs 65.74 lakh crores. Sounds pretty good, straightforward growth.
It does. It certainly signals, continued momentum. That's a decent rise from February's Rs 64.53 lakh crores. Overall, more money flowing in.
But here's the slightly confusing bit. While the total AUM climbed, the average AUM actually dipped, fell 1.33% to Rs 66.70 lakh crores.
Interesting. More money overall, but the average holding size decreased slightly.
Exactly. So, okay, let's unpack this. We've got this Phillip Capital report. It's based on the latest AMFI data, and we're going to dig into folio numbers, SIPs, where the money's really going, especially with ETFs.
And try to make sense of these signals for investors.
That's the plan. What do these shifts actually mean for someone managing their own investments?
Well, that combination of rising total AUM, falling average AUM, it could mean a few things. Maybe the investor base is getting broader, more people starting out perhaps with smaller initial amounts.
Okay, that makes sense.
Or it could be seasoned investors spreading their money across more funds, maybe diversifying more strategically.
Right, could be either. Let's look at participation. Folios, the actual account numbers increased by almost 1%, 0.94%, hitting 23.45 crores in March. That's a lot of accounts.
It is a substantial number. And what's really key is the retail segment, equity, hybrid, those solution-oriented schemes that makes up a huge chunk, 18.56 crore folios.
Solution-oriented, you mean like retirement funds, child education plans?
Exactly those. It highlights that people are increasingly using mutual funds for specific long-term financial goals, not just general investing.
And many are using SIPs, systematic investment plans. The report pegs the number of SIP accounts at a new peak, 10.05 crores. That really shows how popular that regular investing approach is.
Absolutely. The steady rise in SIP accounts shows people value that disciplined approach, rupee cost averaging, trying to smooth out volatility.
Makes sense. But here's another small wrinkle. While SIP accounts went up, the total amount collected through SIPs dipped just a tiny bit in March.
Yes, I saw that. Down from Rs 25,999 crores in February to Rs 25,926 crores in March. Not a huge drop, but noticeable.
So more people are starting SIPs, but the total inflow is slightly less. What could be driving that? New investors starting smaller, like you mentioned.
That's a strong possibility. A new wave dipping their toes in with perhaps more modest initial amounts, or maybe some existing investors slightly paused or reduced their contributions for the month. It's minor, but worth noting.
Okay. Now let's shift gears a bit. Where did the big money move? ETFs and index funds saw a huge surge.
Huge is right. A 23.82% jump in funds mobilized in March. We're talking Rs 40,006.89 crores.
Wow. Compared to about Rs 30,500 crores in February, that's significant. What's behind that? Passive investing gaining serious traction.
It certainly looks that way. Investors seem increasingly drawn to passive strategies. Could be the lower costs, the simplicity of tracking an index, maybe seeking broad diversification easily.
So less about picking individual winners and more about capturing overall market movement.
Potentially, yes. It reflects, I think, a growing awareness of different investment styles and maybe a longer-term view focused on cost efficiency and market returns.
Interesting. So lots of interest in passive. But what about active equity funds? Did they get left out?
Not at all. Equity funds overall still saw net inflows. Rs 25,082 crores came in during March. So active management definitely still has its place for investors hoping to outperform the market.
And within equity, one category really stood out. Small caps.
Yes, small cap funds led the pack with inflows of Rs 4,092 crores.
That's a strong preference. Feels like a bit of a risk-on mood, maybe, chasing higher growth potential.
It often signals a higher risk appetite, yes. Investors willing to stomach more volatility for potentially higher returns from smaller companies. But, of course, that comes with increased risk.
Always the trade-off. Now, on the flip side, the report showed major outflows elsewhere. Debt funds saw a massive pullback.
Massive is the word. A net outflow of over Rs 2 lakh crores. Specifically, Rs next gen 2,002,633.04 crores.
Whoa. Why such a huge move out of debt? What's the thinking there?
Well, it's likely tied to the interest rate outlook. If investors expect rates to stay put or maybe even fall, other assets like equity might look more appealing for returns.
So shifting money hoping for better growth elsewhere.
That's probably a big part of it. Plus, general portfolio rebalancing, market conditions change, allocations get adjusted. Hybrid schemes also saw some outflows, though much smaller, around RHS 946 crores. Maybe some simplification happening there too.
Okay, so a clear flow. Money moving into equity, especially small caps and passive funds, and significantly out of debt. The report also looked at specific fund houses, right? Who gained the most AUM in the first quarter of 2025?
Yes, January to March. Motilal Oswal MF did very well, adding RHS 6,800 crores in AUM. ICICI Prudential MF also saw strong growth, up by RS 6,596 crores. And PPFAS MF had a notable increase too, RS 5,870 crores.
Any others mentioned?
Yeah, some newer players showing good growth too. Bajaj Finserv MF added about RS 1,677 crores, and White Oak Capital MF grew by around RS 281 crores.
Good to see growth across different players. Finally, the report flagged some upcoming new fund offers, NFOs, expected in April 2025. What's coming down the pike?
A few interesting ones. Grow is launching a Nifty 500 Momentum 50 ETF.
Momentum. So focusing on recent winners.
Basically, yes. Investing in stocks that have shown strong recent performance, hoping that trend continues. They also have a fund-of-fund version of that. Both open April 3rd to 17th.
Okay. What else?
Kotak Mutual Fund has two. One is the Kotak Energy Opportunities Fund, a thematic fund focused just on the energy sector. That's also April 3rd to 17th.
The sector-specific bet there?
Correct. And then they have the Kotak Nifty Top 10 Equal Weight Index Fund, open April 7th to 21st.
Equal weight. How's that different?
Instead of weighting by market size, where the biggest companies dominate, this gives each of the top 10 Nifty companies the same allocation in the fund. Spreads the influence more evenly.
Got it. So some specific strategies coming online: momentum, energy, sector, equal weighting. Of course, need to stress this is just info on upcoming launches, not advice.
Absolutely critical. These are just announcements. Investors absolutely need to do their own homework, read the documents, understand the risks and costs, and see if it fits their own goals.
Right. So quick recap. March saw overall AUM grow, but average AUM dipped slightly, maybe broader participation.
Yeah.
Big surge into passive ETFs and index funds. Equity inflows continued, especially small caps. Debt saw huge outflows. Certain fund houses had strong quarters. And some new NFOs are on the way with specific themes.
That sums up the key trends from the Phillip Capital Roundup nicely.
So thinking about all this, the rise of passive, the taste for small caps, the shift from debt, it really makes you think, doesn't it?
Yeah.
For you, the listener, how do these trends maybe make you reevaluate your own portfolio? Does it change how you think about aligning your investments with your goals, your risk tolerance? Lots to chew on there.
It is. And remember, this discussion is based on the data in that specific report. Always do your own research.
And definitely consider talking to a qualified financial advisor before making any decisions. This has just been for educational purposes.